Well, one interesting aspect too that's about the bond market is the way that it's moving it may not seem very volatile to you if you're just looking at it because we're just looking at the outrights. From the perspective of the yield curve, the spreads, just by looking at 15 days of data, add a little bit more data just so it's more visible. But what I'm trying to get to is that we've seen a lot of movement in the past, I would say, yeah, 15, 20 days, 30 days. And that movement has really been in the spreads. Yield curve has flattened. Today, I mean, we're not looking at the spreads. We don't have the spreads pulled up. But if, just as a quiz, for example, based on what you're seeing here, what do you think happened to the yield curve? From, let's say, somewhere around this point, yeah, right around October 22nd, from October 22nd till today, just by looking at the outrights, can any of you tell me what did the yield curve do from 2-year to 30-year? We'll open it up in the spreads afterwards, but no, it didn't invert. Flattened. Yeah, it flattened. It definitely flattened. Gregory, I want to. Why do you say that? Why did it flatten? You're right, but are you right for the right reasons? Oh, and Corey, by the way, the yield curve actually is slightly inverted in some places, but it's not like full inversion. It is getting a little bit inverted though. Good point. They all went lower. Yeah, recently, right? Like for example, this is as of on the 9th of November. They all went lower, but did they all go lower by the same amount? So enough speaking. Now let's get to the spreads. And this is what I mean. This is what I mean by the volatility is really in the spreads. And these are just some of the spreads. These are the ones that were, I guess, the base ones, if you will. The TUT, fight, fob, full, null, knob, and bob. Look at bob. I mean, when was the last time you remember seeing this sort of volatility in bob? I don't know if from the, I think I may have posted this in the Discord room, but this portion of the yield curve did in fact invert, as Corey pointed out, or maybe it was somebody else, but somebody asked if it was a yield curve that inverted. The yield curve did in fact invert, but that didn't occur just now. It occurred, sometime last week or so, between the 20s and the 30s. And it's small inversion, like 5 basis point inversion. And then the other part that really moved was in the front end, particularly between the 5-year note. I want to say the 5-year note is the portion of the curve around the 5, the 3-year note, 5-year note, 7-year note, like that area is what saw the bulk of the movement, and it actually resulted in a something that we can take advantage of. So let's go to that. These are just the cash rates that are based on what the Treasury calls the constant maturity treasuries. So these are the yields for the 2-year note, 3-year note, 5-year note, 7-year note, 10-year note, etc. And the distortion that occurred was that if you compared what let me open up an Excel for this, because without an Excel, it's going to be kind of hard to comprehend what I'm saying here. So here's a 2-year note, there's a 3-year note, there's a 5-year, 7-year, 10-year, 20-year, 30-year. What took place at that around that time is that the difference between 2s and 5s was, if I'm not mistaken, we'll look at the numbers, at the exact numbers in a second, but if I am not mistaken, it was like 26 basis points. I'm trying to group these. So this was like something like 26 basis points, difference between the 2s and the 5s. But then the difference between the 5s and the 7s was something like 70 basis points. It was enormous, right? It was a huge difference. And let me put this over here, just so that we don't get confused. And these are in basis points. By the way, a basis point, for anybody that does not understand or has not heard basis point before, a basis point is 1/100th of 1%. It's expressed as follows. This is 1 basis point. I need 100 basis points to get to 1%. Does that make sense as far as what a basis point is? So when we look at, for example, the 10-year note, and we state, okay, the 10-year note is currently trading at 1.58%. That's the yield on that 10-year note. This is the equivalent of 158 basis points. Why? Because it's 1% and then 0.58. Got it? All right. Just want to make sure nobody's getting confused. Then as far as, since we're throwing out these terminologies, and then the inversion was in between the 20-year and the 30-year. Normally, the average spread in between, let's say, the 20-year and the 30-year, the 10-year and the 20-year, 7-year and the 10-year, etc. Like the average spread that we find in between these securities tends to be around 25, 23, 26 basis points, somewhere around there. And that's just based on the time I've been trading bonds, and ever since I've been trading bonds and I run these numbers, it just ends up being around 26 basis points of spread in between bonds. So that's kind of what I know to be the average. Maybe that's only for the times that I've been trading bonds. Maybe it has been different in the past, but at least for the time being, if I see something that's a lot lower than 25 or a lot higher than 25, such as this, then it sort of lets me know that it's kind of out of line, especially if I run the numbers and I see that all the other ones are pretty much 26, but then one of the spreads is a lot higher or a lot lower. So getting back to the inversion, if we look at the actual number of what the inversion is, and we get that by taking the in this case DGS 20 Fred minus the 30-year. And what we see here is that there is no longer an inversion. There's now a positive value. But this value, when I did this a few weeks ago, I took the yield of the 20-year, DGS 20-year, and I subtracted the 30-year yield from it. This gave me a negative value. And that means that part of the curve is inverted. But now that we're doing it, I'm seeing that the number is not negative. So that part of the curve is just flat, outright flat. So we can put 3 basis points for the difference between the 20-year and the 30-year. Now, if we do the same, let's go grab, for example, the 2-year and subtract the 5-year from it. And then the same thing for the spread between the 20-year and the 30-year. This is, in fact, -3 basis points. I just had the order wrong. If we do it with the order as I should have done it from the beginning, we start out with the 30 and we subtract the 20. Here we get the -0.03, -3 basis points. So this part of the curve is indeed inverted. So the curve hasn't really changed. It's moved a whole lot, but it's sort of snapped back to where it was before all these movements took place. What does that tell you? What does it tell you? I'll just start off, from the top of my head. Number one, it lets me know that the trade that I really like, that the trade that takes advantage of the implied bands, and it's counting on there being movement in the bond market, but not movement that's all in one direction and it just continues going in one direction, but movement that's chop, right? It's up and down, up and down, up and down. So, and I love that movement because it means that the trade works, and it works well. And it's the predictable trade we've discussed ad nauseum in Discord and in other places. And we can look at it here, but just for anybody that hasn't really followed it, the trade is pretty much wait until the middle of the week, and based on certain conditions, if by the middle of the week, we may want to take the opposite side of the direction the bonds have moved. So for example, this week, bonds started the week and they moved down. And then exactly by the middle of the week, right around Wednesday, they hit their implied bands, these lower bands. So the trade is, once this happens, take the opposite side. And more times than not always, but more times than not, within that week, it does the mean reversion, such as this week is a perfect example. Last week was also a perfect example. But then there's there's other weeks that it wasn't, and we went through I would say like a patch of maybe it was like 3 weeks or so back to back where the movement was just in one direction for the better part of the week. So when bonds are effectively trending for the whole week, that trade doesn't really work out if your goal is to get out by the end of the week. But as Jonathan mentioned, earlier, if you're okay with extending your trade, for example, to 2 weeks or a little bit longer, that gives you a much better shot at catching that mean reversion. But yeah, anyway, sometimes that works, and it works very, very well, as you can see here. Even I'm surprised that even the frickin' 5-year note, and this is pretty freaking interesting. The 5-year note, the reason I have the 5-year note here, I have it plotted, that is, normally I just plot the back end, the UV and the ZB, but I chose the 5-year note on purpose, and that is because, number one, that's what's moving, as we just saw, right, with the spreadsheet. That's where the gap is in the yield curve. we didn't finish doing all of these, but I mean, you're already seeing that this one's negative, this one's 26, this one's 70. So, and the difference between the 10-year and the 5-year, if I'm not mistaken, is also 26. But we can do that real quick just to be sure, and then we can move on. So how would I take advantage of this? It has to do with the 5-year. I'll get to it. So we want to see the difference between the 10-year and the 5. Okay, this is at 38 basis points. Notice though that I used the 10 and I did not use the 7. I used the 10-year note, which is really, you know, the equivalent of the TN future. But if I use the 7, it's exactly 26 basis points. I wasn't kidding. When I've been looking at this for several years now at these spreads, and it's always, but it tends to be always around this number, around 25 basis points, 26 basis points. I did not look at this number before class started, and somehow I managed to guess that it was 26. I mean, take it as a, I don't know, something that you can remember. It surely helped me, right? Like remembering that the spread between these instruments that are close to each other, right? The 5-year versus the 7-year, because they're right next to each other along the yield curve. It has 26 basis points of spread. And likewise, if I compare the 2-year against the 5-year, let me just remove this 3-year out of the way. I could also see that it's 26 basis points. But then the 5-year against, which one was 70 again? I apologize, folks. 5-year, I just don't want to give you incorrect information. 5 and 2-year, this one's 70 basis points. All right. And then 7 versus 5, 26. Yeah, I just have that third one there because of the 3-year. So we have this, pretty significant difference. Why? There's 3 years of difference between the 2-year note and the 5-year note, duration-wise, right? 2-year, 5 minus 2, right? 5 years minus 2 years gives us 3 years of duration. And if we compare the 5 against the 7-year, this is only 2 years of duration. So there's 3 years of duration on this spread, and 2 on this spread. Now we could also use the 3-year note just to get that equivalent reference point, to get exactly 3 years here versus 3 years in the other spread. Or actually, no, that would make it 3 minus 4, that would make it 4 years. So there's really no way to make it exactly equal as far as years, but it's close enough, right? You're trading not that many years of duration in the spread, but nevertheless, why is this spread of 3 years of duration 70 basis points, and the spread between the 5 and the 7-year 26 basis points? It shouldn't be that way. I know that this is smaller. This is only 2 versus this one, which is 3. But even if we were to assign an amount of basis points to each year is still being valued at a whole lot more in this spread, in the 2 versus 5. So the 5-year note, if we go to the trade tab and just type it in, ZF, what you'll notice is we can trade futures against this, as I hope you know by now. We have December contract going out in 10 days. And we could already see some of the volume start to trade in the March 2022 contract. And I also want to bring your attention to the option chain. Somebody earlier was asking, how would you trade options? There's options on futures, and most brokers support them. Not all of them, but most of them do. And one of my favorite options on futures trades is on this contract, on ZF.